With a basic understanding of variations of credit contracts and present values under our belt, we can now define and calculate interest rates. As mentioned before, interest rates represent the cost of borrowing to the borrower in a credit contract, and they're of fundamental importance in the macroeconomy. There are several ways to calculate interest rates in practice, and Mishkin in Chapter 4 calculates several of them, providing a detailed discussion. The vast majority of these are approximations, because interest rates are not linear functions of the payment received in a contract. The reason for that is the fact that interest rates compound. In the past, that made calculating interest rates correctly complicated, but nowadays computers and financial calculators do most of the work for you. Consequently, I will skip most of the discussion of interest rate proxies and instead focus on the correct definition, which is the so-called yield to maturity. The yield to maturity is defined as the interest rate for which the present discounted value of the payments associated with an instrument is equal to its current price. It is specific to each bond and loan. I recognize that this definition is not very intuitive at first glance, but as we will see, it is the most accurate equilibrium definition of interest. Before we go to the intuition, let's consider the simplest example of how to find the yield to maturity, a discount bond. The same method also works for simple loan. Say our example bond today sells at a bond price of PTB equal to $997 and offers one single payment of $1,000, its par value at maturity. By the definition just provided, the price of this bond needs to equal to its present value, which is the single face value payment at maturity, discounted back to today at whatever the prevailing interest rate is, I. It's this expression here. PTB needs to equal to PVT, which is equal to the face value payment n periods from now, discounted back in times. Now, assuming for simplicity that the maturity on this bond is 1, we can then solve for I. I, generally speaking, is equal to the nth root of the face value payment divided by the initial bond price minus 1. The nth root, of course, set in equal to 1 goes away, so what you end up with here is simply the future value minus the initial price as a function of the initial price. For longer maturities, I want to be clear that this relationship is nonlinear as mentioned before, and it will include some type of root term. Now in our example, the yield to maturity then is equal to $1,000, the face value payment, divided by the initial price, $997 minus 1, which is equal to 0.003. There's a typo here that PowerPoint wouldn't let me fix. The actual yield to maturity here is of course not 3%, it's 0.3%. Now what does this indicate? It indicates that for each dollar you invested originally, you made back about 0.3 cents. Note that for a discount bond with 1-year maturity, the so-called simple interest rate without compounding is equal to the yield to maturity. The simple interest rate is simply the difference between the final payment minus the original loan amount divided over the original loan amount, and it's typically not the correct definition of the yield to maturity. It's only the case here because there's no compounding involved in a 1-year lending agreement. What do we do with more complicated assets? Of course, most credit titles are not structured in such a single way. Well, in principle, the approach here is the same. Say, for instance, you take out a fixed payment loan for 25 months that pays $216 in each period, and every month that's what you pay back. The present discounted value in this case is equal to these $126 in each month, discounted back in this case by the monthly interest rate for all of the 25 individual payments. Right? So one next month discounted back once, one 2 months from now discounted back twice, and so forth. Again, we can simplify this a little bit using a summation operator. You don't have to do that. It's just a little bit more convenient. Now, how would you figure out the interest rate if the principal on this loan, what you initially received, was equal to $1,000? Notice that from a lender, the principal's perspective is equivalent to the price from a bondholder's perspective. So again, we can find the yield to maturity by setting this price, quote unquote, $1,000 equal to the present value of this loan. Now, in order to find yield to maturity, what you have to do is you have to solve for I. This is possible. You can, in principle, do this on paper. What you're looking at, though, is an nth order polynomial, and factoring that out on paper would take a prohibitive amount of time. In practice, therefore, we use computers or financial calculators to calculate interest rates for this purpose. And I will not let you do this, or, I mean, you can do it, of course, but I will not have you do this for testing purposes or similar on a more complicated asset than a discount bond. Just for your information, in this particular case, the yield to maturity is equal to 12%. Instead of dwelling on the math, let's focus on intuition. As I mentioned initially, the yield to maturity is the equilibrium interest rate, indicating that the price of an asset equals its actual expected value. This follows from the assumption that in equilibrium there can be no financial arbitrage. Now, this is a term you might be familiar with. If not, in general, arbitrage refers to making a profit without incurring any economic costs. This is possible, for instance, if a bond sells above or below its present value. As a simple example, consider a discount bond that sells for $990 and pays a face value of $1,000 1 year from now. Meanwhile, say the interest on a 1-year bank loan is 0.5%. Using this rate to discount the bond, its present value is $995, which is obviously more than $990 it sells for. An arbitrager could borrow $990 from the bank, buy the bond, receive $1,000 on the bond from a year from now, and pay the bank back $995 they owe at the current interest rate, making $5 of a risk-free arbitrage profit. Now, in practice, there are entire industries of arbitrageurs that attempt to identify such differentials, and for that reason, persistent arbitrage profits are rare. If a bond sells under value, more arbitrageurs will try to buy them, which in turn drives up the price of the bond. That makes the arbitrage profit go away over time. Similarly, when an asset sells above their present values, arbitrageurs will try to sell them, which pushes the price back down until it approximately equals the present value. For this reason, in equilibrium, asset prices need to match their present value, which implies that the yield to maturity is in fact the equilibrium interest rate for a specific credit instrument. Whenever you read no arbitrage conditions in finance or economics, in a paper or in a textbook, this is the process it refers to. Moving on to an important aspect that you may remember from principles. This table here lists a hypothetical range of yield to maturities on a coupon bond that sells at different prices in the left column here and has a face value of $1,000. In general, what you will notice is that the higher the price of a bond today, the lower will be its yield to maturity. That is to say, bond prices and interest rates are inversely related. If you don't remember this from principles, it's not a big deal, but keep that in mind. It's a fundamental relationship of finance, and it turns out it's one of the mechanisms by which monetary policy operates. Now, why is this the case? You can do the math. You can go back to the definition of the yield to maturity, and you will see that the price and the interest rates in any equation that you can really build there, doesn't matter how complicated the instrument is, will always be inversely related. As a matter of fact, the interest rate and the bond price are jointly determined. So it's not causal. It's more that saying the interest rate increases and the bond price decreases are saying the same thing. What's the intuition here? When you buy a bond, or when you issue a loan for that matter, what you really purchase is a contractually fixed stream of future payments. You know exactly what the payments are going to be in dollar terms on a coupon bond. Now, if you pay a higher price for this today, if the bond price is higher, that means for each dollar you invest, you make less in interest. And of course, what you invest for each dollar is by definition the interest rate you earn.